Hello, everybody. Thank you very much for joining the FX London Open Breakfast. And I'm just double checking that you can hear me. Well, obviously, the first thing that, of course, we need to talk about is is going to be the euro. Now, I'm just double checking that you can see this euro chart on the screen. I believe you should be able to. It's just a 60-minute euro chart. But the first thing that we need to talk about, of course, is going to be those FOMC minutes. That were released yesterday evening UK time, and which really kind of dominated the markets and continues to dominate as we open in the UK session. So you should be able to see here this very sharp drop. So we had got stuck around the 133.50 area, but we had been in between that kind of 133 to 133.50 range for the last couple of days. Well, we shot below that, as you can see, down below some key moving averages, really, really sharp move you can see here, all the way down to kind of 132. So we lost kind of 150 pips as the statement was coming out, so as it was being released. And this really shows you that, you know, the kind of the quick pace of decline, you know, the impact that you know, the Fed can have on the market is unbelievable. Someone has just asked if there's sound. I believe that sound is fine. So maybe you need to check. Maybe they need to check their own computer. But as you can see here, been a bit of congestion really around this 132 mark. So we did find some support around 132.20 originally. However, we did decline again. Now this obviously we're testing 132 right now. Below here, we obviously what comes into line then is this 131.50. Now, interestingly enough, this is a key line, a key support line on the daily chart, which we're going to take a look at right now. So as you can see, we've actually gone through it. It was just kind of a bit of a trend line really. Just kind of dating back from kind of that 130 low. We've gone through it. We are testing these kind of really important cluster of daily moving averages around that 132 handle. So that is really, really important because below here, so below that 132 mark, there obviously is incremental support. As I mentioned, there's obviously 131.50. But then below that, it really opens the way to that really important 130 zone. Now, central banks, and you know, even if you're a hardcore technical analyst, you will have looked at your charts yesterday. Let's go back to the daily chart. You wouldn't necessarily, you may have thought that, you know, that we were looking a little bit sticky around this 133.50 zone. That we, you know, interestingly enough, we'd made 133.80 the previous day's high. We'd had kind of a lower high, that things were going to be weak, but you'd never predict that huge fall. So it does show that, you know, even the most hardcore technical analyst does need to concentrate on what central banks are saying. And that's why today is really important. So for those of you who don't know, the ECB is meeting a day early because of that Easter holiday. So they're holding their meeting today. Now, they announced interest rates at 12:45 BST, so British Summer Time, which is 1:45 Central European Time. However, they are not expected to make any changes to interest rates or to announce any new developments there. What's going to be much more important is the press conference following the announcement. So that's Draghi's press conference. That takes place at 13:30 British Summer Time, which is 2:30 Central European Time. So this could be very, very important. If we, you know, essentially the ECB may not be as dovish as some expect, which could potentially kind of limit downside, could make this 131.50 to 132 level incredibly sticky for the time being. Now, we would also point out that this morning at 9 o'clock, we have got European non-manufacturing PMIs coming out, and we're fairly neutral on the euro actually at the moment. I want to wait for that non-manufacturing PMI to come out of Europe. Just bear with me one moment. I'll just show you what I expect to do. The market is looking for it to remain unrevised really, but at a very low level of 48.7. France and Germany just scraping there into kind of positive territory. But it's obviously the periphery where the real weakness is lying, and we expect that to continue. Added to that, we also have a Spanish debt auction at 9:30. Now, all of these things are really important. The market has been focusing on the growth data coming out of Europe and really reacting to it. At least in the short term anyway. We did see a big negative reaction on Monday on the back of that kind of weak PMI data that came out. So that's been also closely watched. Obviously, we've seen some strains rising in Spain. The Spanish bond yields right now are really, really close to that kind of key support level at just bear with me one moment. Let's just take that camera off 1 second. They're very close to a key resistance level at 5.5%, which I will show you now. Actually, you can just take a look at that. Just so you get an idea of, a lot of people are talking about Spain, about Spanish bond yields, just to get an idea about what they mean. This is, Spanish 10-year yield is currently trading around 5.46%-ish. It was as low as, but it was below 5% at the beginning of March, but it's nowhere near as high as that kind of 6.5 or above, like say 6.7% actually, that we reached in November, the 25th of November last year. That was just below 6.7%. So, definitely moving in the wrong direction, very much within the recent range, but we are getting very close to this kind of key breakout zone at 5.5%. We believe that if we do break above 5.5%, that's going to be very bearish for risk generally, because risk assets, including stocks, especially here in Europe, and also the euro itself and the Aussie, and the better outperformance of safe havens has got a very good correlation with what's been going on in the peripheral bond yields, especially Spain, because obviously Spain is a little bit too big to bail. That's Spain's biggest problem, is that it's the fourth largest economy in the Eurozone, and it's looking very weak. I mean, its debt levels have risen, its budget wasn't necessarily accepted that well in the market. Now, that's a lot of context that's going on for all these price actions. So let's go back to the price action, because the other thing I really want to show you is the Aussie dollar. The Aussie dollar has been hit tremendously hard. As you can see, don't you remember, like Monday last week, we were talking about what was going on about this kind of really key level here around the kind of the 104-ish, 103.80 level. There was kind of a convergence of the 200-day and the 100-day moving averages. Well, see, that has been, absolutely shot through. It fell through. This is a daily chart as well, which is, suggests that it's, as you can see, this is, we've seen a sharp drop in the Aussie. This is a daily chart. As you can see, the RSI is also pointing lower. And this is on the back of those Fed minutes. Obviously, the markets are very jittery. Someone's just said that, made a very valid point that analysts have been saying that there was QE, the potential for more QE last week. Today, they're saying there's not. Obviously, nobody knows what's going on unless you're sitting in the room. That I think that is a good point. But the markets are very jittery. They are, we've been so reliant on QE to boost asset prices, risky asset prices, for the last kind of 4 years, really, that for it not to be, of course, now that it seems, now that we're in a kind of a slightly different environment from what we were in 2 years ago, with the US economy picking up steam, of course we're going to be very jittery and looking at what's going on. Now, for Australia, obviously on a technical perspective, once it's shot through those key moving averages, then there's a technical bias for it to go lower. Add into that the prospect of, some slightly more hawkish minutes from the Federal Reserve, no matter how kind of futile or it may seem to trade some of these things that the Fed keeps telling us. I understand that very well from the last kind of, 6-8 years in the markets. But on the other hand of that, we also have some very weak Australian data, and the Australian economy is starting to look weaker and weaker. And I'm getting slightly worried about it, actually, and kind of worried about the ability of the Aussie to rebound at any stage. It looks right now to me like it's in a really, a bit more of a prolonged downtrend than I think some were thinking. now very much opening the way to parity to me. We've had weak Chinese data, but we also had very weak Australian trade data. So not only have we seen pockets of weakness in the non-mining sectors of the Australian economy this week, for example, in retail sales, but we also have started to see that shipments of kind of these minerals and iron ore, for example, that have been very, very important at propping up the terms of trade for Australia and propping up the Aussie, propping up the economy at large, is also starting to wear thin. So that is really, really worrying. And I want to show you another chart, which some of you may have heard of, but you may not have seen very often. It's called the overnight index swap chart, and don't be scared by it at all. All it is just, it just shows you kind of where we think the interest rates will be in kind of a month's time, or each month out to a year. And just to draw your attention kind of down here, right now, interest rates in Australia are 4.25%. For the next time they meet, which is in kind of a month's time, as you can see, by 2 months they're expecting pretty much a sizable cut. So certainly within 3 months, it seems like we're pricing in right now already a cut in the next 3 months, and that cut could come as early as next month. So as you can see, real sharp decline, tends to be, the overnight index swap rate is what's used to kind of price, or I guess to predict really the where interest rates are going in the future, obviously. And as you can see, that is really really kind of curved downwards. And as I said, markets aggressively now pricing in a cut for Australia. So this is just something to watch out for when people say, like, interest rates and currencies and things like that. As you can see, a slope like this suggests that, the markets are pricing in for much lower interest rates in the next 3 months. In fact, a whole cut in the next 3 months. And that could actually come in as early as May, especially after the data that we've seen out of Australia already. Let's go back onto our Australian chart. So as you can see now, once you lose that pillar of interest rate support, you really, the currency can really take a bit of a hammering, and that's what we've seen in the Aussie over the last since the start of the year, really. Let's take a look at this on a different time frame, just to see if there's kind of any sense that we are where we could go first. Now, let's just go back to the daily. I just want to draw your attention to the RSI. So it's moved really kind of, it's moved consistently lower, currently around that 40 level. We really need to, we're not really in oversold territory right now. However, on a shorter term basis, we are, and we seem to have found a bottom around that kind of 102.75 level. I think that's quite important. It suggests that between kind of 102.50 and 103, we could potentially find, be a bit sticky. Certainly, the low of today has been 102.62, so we're smack bang in the middle between that and 103, which would of course be a key resistance level now. But the fact that, even yesterday, the high in sterling was 104.50, well, it looks today like the high is going to be 103. So, really kind of just reinforcing that weakness in the Aussie. Also, as you can see, this noise here came from a much better than expected Chinese PMI figure, which was not necessarily give a clear account of the Chinese economy, which is of course very important for Australia. But it does show that, Australia is reacting much more to bad economic news than it is to positive economic news. And just from kind of looking at the directional indicators there, we could find a bit of respite. But I would say that looking at the longer term chart, it looks weak to me. It looks like we've opened the way to parity. Of course, there's going to be a lot of incremental support on the way down. We can take a quick look. Let's just take a quick look at the Fibonacci retracement. So if we think of our highs here at around kind of 110-ish, if I try and grab 110 with that low from November at kind of 95-ish, there are some really key levels. The 38.2 comes in at 101.10. That's going to be a really key support level. That would be the 61.8% retracement lower of that entire move. Then, of course, we've got parity, which is just going to be absolutely pivotal. Now, someone said, do you expect the Kiwi to follow the Aussie lower? Well, interestingly that you said that actually, because Aussie Kiwi was at its lowest level in 6 months. Now, the Kiwi economy is slightly different from the Aussie economy in the fact that it's kind of lagged on the way up, or for the good time, for the Australian good times, if you like, which suggests that it may also lag on the way down. And that's because its export mix is less mineral, so less kind of commodity-based, less reliant on China being this massive export powerhouse. And it's more, it's obviously a lot of dairy, a lot of food products. And what we do know is that its diet is changing, and so the world is eating more, and that should be good for New Zealand because it's a big food producer, especially in desirable foods like meat, like dairy. So that's it from kind of a very interesting fundamental perspective, I think. But let's just take a look at that chart because obviously yesterday, those of you who watched our video, so our video blog, our London session video blog, which is on our website, will know that we were targeting 125.50 ahead of kind of potentially this 124 low. As you can see, very much Aussie has been weak across the board. Of course, Aussie dollar is the most widely traded Aussie pair, and that's why it's kind of been falling. Again, it's below some really key daily moving averages. Slightly starting to look oversold though here. Hence this kind of this more meander lower towards that 126 handle where we are finding a bit of stickiness. Looking at it from a daily chart, however, we've seen it bounce back slightly, but again, we think that gains are going to be thwarted, and that we would certainly use any gains to sell on strength. So potentially we could see a move up to kind of 26.20, then just below kind of 26.50, and we've used that as another selling point because we do think that the Aussie is looking fundamentally weak now, and obviously Aussie Kiwi, because of the way that the Aussie is traded, it's largely traded against the US dollar, and that kind of means that it could weakness in the Aussie US dollar, Aussie versus US dollar, should translate into further weakness on Aussie Kiwi. So again, as we said, buying into selling into strength there, we think, certainly in the short term anyway. Now, obviously New Zealand does have kind of links with Australia. If Australia's economy is to have a sharp slowdown, it is an important trading partner of New Zealand, so there will be a knock-on effect. But we think that would happen with a lag. And even though we're pricing in right now for a rate cut in May from the RBA, and also kind of further economic weakness, we think potentially the Kiwi could still outperform the Aussie dollar, at least in the very short term, as that pricing in gets sold. Someone's just asked about euro dollar, so I will go back to that chart because obviously these are really the pairs that are dominating today. But I do want to look at dollar yen as well because there was some very interesting things there. Now, someone just mentioned that 133.80, as I pointed out, was a really key level and could potentially be the top for the second quarter. Well, obviously we're only 3 trading days into the second quarter. 4 for FX, of course, what was the Asia Open. But it's a bit early to say, I think, for the second quarter. I certainly think for now, and by that I mean, it's going to take a huge turnaround, either from the ECB or from the non-farm payrolls report that we get on Friday. So right now, all signals are pointing to a very strong labour market report in the US on Friday. The market expects kind of 200,000 plus jobs created. And the ECB is likely to not offer any more support to the struggling sovereigns, which we believe is going to be euro negative. Of course, because the sovereign fears are starting to raise their head yet again, and what we're instead of seeing a central bank who's willing to help and sort out that problem, they're kind of allowing it to fester, which means that it will probably get worse, and then they'll have to react as they have done for the last 2 years when things are particularly bad. We've certainly seen, the impact of the LTRO, so those long-term debt auctions for the banking sector. They certainly had an effect, but the effect may have been fleeting. So, there's lots of things, there's lots of moving parts here of why the euro could fall. Someone said that they expect kind of 120. I do think that the euro is vulnerable actually if it gets below 130. Of course, this low here from November, so it's kind of like 126.30 130-ish, just below 126.50. That's going to be a really key resistance level. We also had the other reason why I think the euro is going to be vulnerable below 130 is that in the past we've had a lot of say for example China FX reserve diversification, Japan as well. Well, both of those countries are now in deficit, have seen their surpluses narrow and actually move into deficits. That means that FX reserves have shrunk over recent months, which means this time round, if we see kind of a sharp fall lower in the euro, then that could potentially be very negative, euro negative. We think that is not necessarily that there's not going to be that pillar of support in the euro anymore. So there may not be kind of a floor, but we think that things would have to get much more serious for that to happen right now. We don't necessarily see that happening. Someone just mentioned that last month the non-farm payroll, so the US labour market data, was bearish for the euro. It certainly was in the short term, even though we did remain within a range, I would argue. And yes, one of the reasons why is that if you get a very strong labour market report this Friday, for example, that could also weigh on the euro, largely because again it prices out this prospect of more QE from the Federal Reserve. Because obviously they're only going to give more stimulus, which tends to be dollar negative, if the labour market weakens. So if you see positive labour market data, then that suggests they're not going to do any more QE, which is actually then seen as being dollar as a sign for dollar strength. However, that's usually a knee-jerk reaction, so to the NFP. So remember that the NFP can be very whipsaw reaction, and then once the dust settles, as we saw last month. And then the euro fell back into its range, so kind of that range between kind of 130, 150 on the downside and 133.80 on the upside. We haven't, convincingly broke that yet, but we do believe that if we get below 130, 150, then potentially that opens the way to 130. But we do think, obviously, 130 is a massive level. Of course, it's going to be respected by the market. Everybody is looking at it. As I always say, you cannot, technical analysis is spotting these big levels that the market is looking at, and 130 is one such level. So that's kind of a really, really key thing to point out. Obviously on the downside right now, let me just take a quick look at pivot points. Bear with me one moment. I'm also going to show you the point of figure charts in a moment as well. This is just Bloomberg's yearly pivot chart, which I just look at as kind of just to give me a bit of it, just to anchor me in the market as we move to these kind of important levels. Obviously, we're currently below the pivot point because the pivot point is 132.72 on a daily chart only, please, going back a year. And we've got very good support, 131.75. And also 131.18. So kind of some key levels there to watch out for on the downside. And obviously on the upside, again, it's that kind of 132.72 level that is now acting as really big, it was really key resistance. Now let's also take a look at the point and figure, because I do like a point and figure chart. And then I'll also take a look at the point and figure for the Aussie as well, because that would be very important for us going forward, we think. So here's a point and figure chart for the euro, and as you can see, this is like a historical chart. It's a yearly chart. We are very, very weak within our range. As you can see, we haven't really moved a whole lot. Certainly in the last kind of certainly this year anyway, we've been very much range bound. But as you can see, some really key levels on the downside. On a longer term basis, looking incredibly weak within kind of a long-term range, which suggests that further strength toward is going to be quite difficult to muster. So now, on the upside, certainly 134 is that major resistance level. But really, we're concentrating on the downside here. Obviously, 131 here is holding as very, very good support, but then of course below there we have to look at 130, and then below there 128, and then of course even below 127. Now on an intraday basis, as you can see, found very, very good support at this 131.85 level. Okay, I'm only going to get excited. I'm only going to think there's going to be a rebound in this price action if we were to get above 132.30. Now the pivot point said 132.70, so I believe if we've got above 132.30, then we'd then test the 132.70. But I think the risk is definitely to the downside today. Obviously, we have found some fairly good support here on an intraday basis at 131.85, but I still think that the bears are going to be a little bit. The bears could potentially be in the ascendancy. There's a couple of things just to point out, though, just to hedge myself, really. Obviously, the bounce backs have been getting higher. So, obviously, 131.85 could be support for now. We could go up, kind of retest this kind of 132 zone, which we said would be very sticky, and then make our way down again. So, potentially, it's kind of, again, it's another sell on strength, because just pointing that out, certainly in the very, very short term, so I'm talking like the next couple of hours or into that ECB meeting, we have had stronger pullbacks here, as you can see with these two columns here. The first pullback only got to kind of 131.95 and then fell again. The second got all the way to kind of 132.10 and then fell again. So do kind of watch that, but it does suggest that, the bears are coming in. But it could mean, rather than kind of sell here, if you were thinking about that for euro dollar, you may want to wait until we get kind of another one of those bits of strength. Now, I did say that we'll look at the Aussie like this as well, because that is really helpful. Let's have a look at the pivot. The pivot's going to be a bit crazy for Aussie because of what's gone on overnight. So as you can see, yes, the pivot point is miles away. It's at 103.66. Obviously, that 102.66 level, which was really good support there, has held, that was the low of today, and then of course 102. Let's take a look at the point of figure chart as well. I do like a point of figure chart. It just kind of lays everything down. This is the intraday chart. So as you can see, incredibly weak, real sharp move lower. Interestingly, we've also seen kind of a similar-ish type thing. We may have gone a bit too far already. So similar type of pattern here to what we saw in euro dollar. So it just suggests this kind of 102.60 zone really, here we go. You should be seeing the chart now. This 102.60 zone is really, really key support. Very similar reaction to what we saw in euro dollar, in the sense that the pullbacks have actually been getting slightly stronger as we progressed through the Asia session last night and into this morning. But potentially that means for us, kind of, it's going to be a sell on rally, so anything up towards 103, which is now the key resistance level. So that is kind of worth pointing out, because it does just suggest that potentially, investors getting a little bit, we're getting a little bit oversold around that 102.60 level, which of course we know, and we've seen in the, we've got confirmation from that from the relative strength index as well. Okay, everybody, I'm going to leave you now. I hope that you all have a good day trading. I hope that was useful. As I said, do watch out for all that data that's coming out. It's a hell of a lot. We are, the dollar seems to be in ascendance at the moment for very good reasons. Technical analysis is also pointing to weakness, especially against those big crosses in the Aussie dollar and also in the euro dollar. I know I concentrated on those today, but I really think it's worth paying some time to those big crosses, because they are at really important levels, potential breakout levels. So I am not going to be holding this on Friday or Monday because of those Easter bank holidays. Have a lovely long weekend. Good luck trading. And good luck today. And remember, watch out for that ECB meeting. It takes place at, watch out for the press conference, definitely. That's at 13:30, so if you get a chance, do that. And yes, everybody who celebrates Easter, happy Easter. And I will see you next Wednesday, so in a week's time. Please join me then. Bye-bye.